Draw on liquidity is one of the most important concepts in ICT trading, yet it's also one of the most misunderstood. Most traders struggle to identify the correct draw on liquidity, leading to poor bias and losing trades. In this video, I'll walk you through a simple and repeatable process to identify the correct draw on liquidity step by step. So, the draw on liquidity is the main reason the market actually moves. If you truly understand why the market is moving and where it is trying to go, a lot of confusion in trading automatically disappears. The draw on liquidity is basically the area of price that the market is being pulled toward. In simple words, it is where the market wants to go next. Most of the time, the market is moving toward internal or external liquidity. That is what drives price. So if I can correctly determine where the market is actually drawing to, then I don't need to guess entries. I can use the lower time frame to plan my trades, manage my risk, and align everything toward that higher time frame target. When it comes to finding the draw on liquidity, I personally like to keep it very simple. I usually focus on old highs and old lows, equal highs and equal lows, and sometimes unfilled fair value gaps. These are the areas where liquidity is commonly resting, and honestly, it's not as hard as most people think. When I'm trying to form my daily bias, or even when I already have a bias, the main thing I ask myself is this: where is the market actually heading to take liquidity? That question alone gives a lot of clarity. If I believe the draw on liquidity is higher, then I am not interested in taking short positions. And if I believe the draw on liquidity is lower, then I am not interested in taking long positions. This one rule keeps me from fighting the market. I don't try to predict every move. I don't try to trade both sides. I simply align myself with where liquidity is resting and let the market do what it naturally wants to do. Once you understand the draw on liquidity, everything else like entries, confirmations, and trade management becomes much easier and much more logical. So now let's move on to how we are actually going to figure out the draw on liquidity. And for that, I want to talk about something very important, which is the validation and invalidation of PD arrays. When I sit down to trade for the day, the first thing I want to understand is where the draw on liquidity is. To do that, I use PD arrays to my advantage. It can be a fair value gap, an order block, or any PD array that makes sense in the current market context. Let's take this example on Euro. On the bigger time frame, you can see that price has been moving upward, and we already had a sell-side liquidity sweep on the 4-hour time frame. After that sweep, price starts trading into a 4-hour inverse fair value gap. Because of that, my expectation is simple. I want to see this 4-hour inverse fair value gap get respected, and I want to see price bounce from it. Now, if we zoom down to the 15-minute time frame, we can see more confirmation. On the 15-minute chart, price has also swept sell-side liquidity, and at the same time, it is reacting from that 4-hour inverse fair value gap. So now a very important question comes into my mind. If price has already swept 4-hour sell-side liquidity, and if it has respected and inversed a 4-hour bearish fair value gap, then where is price actually headed next? To answer that, I ask myself another question. What is the next opposing significant high, or what is the next significant PD array that price could be drawn toward? When I look to the left, I can clearly see this high. Naturally, that high becomes a potential draw on liquidity. However, this is where most traders get confused. As you can see, price initially fails to take that high. Instead, it forms a high just below it and then retraces back into the inverse fair value gap. Most traders at this point start thinking something like this. There was 4-hour sell-side liquidity, so price should have taken that high. That was my draw on liquidity. Why didn't it happen? This is where you need to understand something very important. The draw on liquidity does not mean that price must immediately go and take the entire obvious high. The draw on liquidity simply tells you the directional intent of the market. What you are actually looking for is the low-hanging fruit that aligns with that draw on liquidity. And if you don't understand what low-hanging fruit means yet, don't worry. I'll make a separate video explaining that concept in detail. Now, in this scenario, what is the low-hanging fruit? This high right here. Does price eventually end up taking that high? Yes, it does. And that is exactly how you use the draw on liquidity. You don't force price to go all the way to the biggest, most obvious level. You align yourself with the direction of the draw and look for the most achievable liquidity target that price is likely to take first. Once you understand this, identifying the draw on liquidity becomes much more practical and much less confusing. You stop expecting the market to do exactly what you want, and instead, you align with what the market is actually capable of doing at that moment. So now, as you can see, price has formed a high just below the previous high that we were considering as our draw on liquidity. At this point, something important happens. We now have equal highs. What do these equal highs actually tell us? Equal highs show that price is becoming more willing to move toward that area. You can think of it as the algorithm showing interest in that level because liquidity is building there. At the same time, you can clearly see that price is still respecting the inverse fair value gap and continuing to bounce from it. Because of that, my draw on liquidity is still higher. So now the question becomes, where exactly should we target in alignment with that draw on liquidity? In this case, we don't want to blindly aim for the extreme high. Instead, we want to plan a clean and realistic trade from this level to a target that makes sense within the context. So let's walk through what happens next. After the sell-side liquidity sweep on the 15-minute time frame, which bounced off the 4-hour inverse fair value gap, we then get a change in state of delivery. Along with that, we also see a fair value gap forming. What does that show us? It shows that bullish intent is starting to step in, and because of that, I can now comfortably look to take a trade using that fair value gap as my point of interest. Now we wait and see what price does. When price retraces back into the fair value gap, it also sweeps sell-side liquidity again. That gives us even more confidence that the market is positioning itself to move higher. Now what I want to see next is a bullish confirmation on the lower time frame. The first clear confirmation we get here is a bullish order block. So this becomes our entry. We place our trade at that order block. We place our stop loss below the recent low. And for our target, we aim for the recent high, which is perfectly aligned with our draw on liquidity. Now let's see how this plays out. You can see that when price taps into the order block, price action is a bit choppy at first. That's completely normal. But in the end, price does exactly what we expected and moves cleanly into our target. Now let's talk about something important. What would have happened if we had targeted the actual extreme draw on liquidity, meaning the equal highs above? Yes, price eventually does go there and takes those equal highs as well. But I would not recommend targeting the extreme draw on liquidity as your main target. A better and safer approach is to take profits at the recent high or recent low that aligns with the draw on liquidity or at any unfilled PD arrays that price reacts from. From there, if you want to let the trade continue, you can move your stop loss to break even and allow price to keep moving in its direction. This way, you lock in profits, protect your trade, and still give yourself the chance to benefit if price continues toward the larger draw on liquidity. This is how you trade the draw on liquidity in a practical way, without forcing trades or holding positions unnecessarily. So now this is where validation and invalidation of PD arrays actually help you understand your draw on liquidity. A lot of traders think draw on liquidity is just about marking a high or a low and waiting for price to reach there, but that's not how it really works. The draw on liquidity is something that gets confirmed or denied as price interacts with PD arrays. When price respects a PD array, that PD array is getting validated. When price disrespects or displaces through a PD array, that PD array is getting invalidated. And this information alone tells you a lot about where the market is actually trying to go. Let me explain this in a simple way. Suppose price is trading higher, and you're trying to figure out if the draw on liquidity is still higher or if it's shifting lower. Now, if price comes into a bullish PD array, like a fair value gap or an order block, and price respects it and reacts strongly from it, that PD array just got validated. What does that tell you? It tells you that the market is still comfortable moving in that direction. It tells you that the draw on liquidity is likely still in that same direction. Now let's flip the situation. If price comes into that same PD array, and instead of reacting, it displaces straight through it, then that PD array just got invalidated. And once a PD array is invalidated, you have to ask yourself a new question. If price no longer respects this area, then where is price actually trying to go? That's when your draw on liquidity starts to shift. This is why validation and invalidation are so important. You don't force a bias, you don't assume the draw, you let price show you. For example, if you are expecting price to move higher, but price keeps invalidating bullish PD arrays and starts respecting bearish ones, that's the market telling you that the draw on liquidity is no longer higher. On the other hand, if bearish PD arrays keep getting invalidated and bullish PD arrays keep getting respected, then the draw on liquidity is clearly higher. So instead of guessing where the market is going, you simply observe which PD arrays are getting respected and which ones are getting broken. That's how you refine your bias. That's how you avoid being early. And that's how you stop fighting the market. Validation shows you where price is comfortable trading from. Invalidation shows you where price no longer wants to trade. And when you combine that information with highs, lows, equal highs and lows, and higher time frame context, the draw on liquidity becomes very obvious. You're no longer predicting. You're just reading what the market is already telling you. This is how validation and invalidation of PD arrays guide you directly to your draw on liquidity and help you trade with clarity instead of confusion. I hope this helped you understand why validation and invalidation of PD arrays are so important and how they directly guide you to the real draw on liquidity. Once you stop forcing levels and start observing which PD arrays are being respected and which ones are getting broken, the market becomes a lot clearer. You don't need to guess where price is going. You just let price show you, step by step. Focus on context, stay patient, and let the market confirm your ideas instead of trying to predict them. If you found this video helpful, make sure to like the video and subscribe to the channel. If you want to connect with me, you can join my Telegram and Discord. The links are in the description. And if you want to learn personally from me, you can check out the mentorship program. The link is also in the description. That's it for this video. I'll see you in the next one.